Welcome. You are listening to Purpose Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casinos, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Bina.
Welcome to Purpose Driven Wealth. I'm your host, Bina. Today on the show, we have Akhil Patel. Akhil is a director of Property Share Market Economics, which is an investment research service that teaches its subscribers how to remember the future based on leading knowledge of economic and financial cycles. He is also a returning guest on the show. Akhil, welcome to the show.
Thank you very much for having me.
Yeah, thank you again for coming on to the show again. When you were last on about a year ago, we discussed economic and financial cycles and specifically the 18-year real estate cycle. And for the listeners who are tuning in, if you'd like to kind of listen to that interview, please check out episode number 28. It's titled Understanding Economic Cycles and Implications for Investors. But since that time, Akhil has now authored a book titled The Secret Wealth Advantage, How You Can Profit from the Economy's Hidden Cycle. Akhil, can you kind of talk about your motivation for writing the book?
Yeah, so I wasn't the person who discovered the 18-year real estate cycle. It's been known about for some time, but I wanted to create something that people could use practically. So you kind of take the information about the cycle, you distill all the insights that other people have come to, but then you answer the question, so what? And that's basically what I wrote. I mean, I do explain the cycle in quite some detail, as you will have seen. And I explain why it happens, how it works, and why no one sees it. But I also include in each chapter sort of a key takeaway. I mean, effectively, I wrote the book that I wanted to read when I first started researching this area.
What are some kind of key insights that readers can take away from the book?
So, I mean, the key insight, I suppose, is understanding the hidden cycle. It's the 18-year cycle. It's responsible for all the major periods of boom and bust in Western economies since 1800. And the average duration is actually fairly regular, other than when it was interrupted by the two world wars in the 20th century. Typically, it's structured as 14 years up, 4 years down, and the 14 years up is itself interrupted by a mid-cycle slowdown around year 7, 8. There's some variation there. So just knowing that, I think, is the first key takeaway. Then I take the reader in the book through each of the stages. I've created 9 stages out of that, and I illustrate each stage with a different episode from history. I say here are the kind of key things you need to look out for when you're going through that stage of the cycle, and then I finish each chapter with a series of investment actions that people can take if they want to take advantage of that stage, or if they want to protect their wealth in the more difficult parts of the cycle. So you get a pretty comprehensive understanding of how the cycle works and what to do about it. And then in between each of those stages, I explain why the cycle happens, why real estate is so important, how kind of that sort of insights about real estate, how they apply in the digital age, why people don't see the cycle, how money and banking fits in, and various other things. So yeah, I think you come away from the book, I hope, with a pretty clear, deep understanding of how the cycle operates and why it operates.
Yeah, and I think you may have already alluded to this, but within the book, you have these sections that are titled the Handbook of Wealth Secrets at the end of every chapter. Why did you include these, and why would it help the reader in kind of understanding or have these kind of wealth secrets?
Yeah, I mean, look, it's, books these days need to be practical. And I sort of felt that it's quite good in structuring a book to have a section where right, here's where the practical information is located, so that you can go back and sort of refresh your memory and so on. So that's why I sort of put them at the end, but also you could almost read the Handbook of Wealth Secrets, each part of it, sequentially. So you could just go to the end and read them one by one, you'll see the kind of the ebb and flow of investment decisions across an 18-year span. I thought that was quite an interesting way of approaching it, which if I'd embedded all the lessons in the text, it might have been a bit more difficult. The readers will have to tell me if that works or not, but that was the idea.
So in essence, that's kind of maybe like the Cliff Notes or the abbreviated version in terms of like the takeaways for readers, and the rest of the chapter is kind of maybe providing like more foundational knowledge and background leading to kind of like the takeaway that people can would have with regards to maybe that particular phase or that particular portion of the 18-year cycle.
Yeah, I mean, it's not quite the Cliff Notes in the sense it won't set out, you know, all the different steps that take place at each stage of the cycle, but yeah, the key takeaways for sure.
Okay. And who is the book kind of aimed at, and who would benefit the most from reading it?
Well, the core audience is, you know, investors, particularly retail investors who are looking to make their own, you know, be in charge of their own investments. But even if you're, if you're investing in sort of ETFs that just track the market, there's some pretty important insights about when the best time to buy and when the best time to sell is. So I sort of have the investor very much in mind. I also include some insights for business owners, because of course, business owners make some pretty major investment decisions themselves, capital investment decisions, when to finance, how to finance, when to exit, when to acquire companies. And so they can use a cycle to finesse the timing of those. Certainly you don't want to be doing too much expansion right before the peak of the cycle, for example. On the other hand, if you want to exit, the best time to exit is just before the peak, when people can pay a high price and can borrow money from banks to do so. So that's the kind of core audience. But the reality is that everyone, you know, whether you're an investor, whether you're an employee, a business owner, a citizen, we're all affected by the cycle. The crisis at the end of the cycle is a major economic and to a certain extent political event, and it changes everything. And so I wanted to create something that was readable, that anyone could potentially, if they felt interested in understanding the system and how it operates, could do so. And that's why I've got, you know, tried to illustrate it with interesting stories. I've taken some pretty complicated economic concepts and I've tried to explain those really clearly. So the core audience is the investor or the business owner, but you know, I'd actually really be delighted if it reached broader than that.
Yeah, well, I mean, you kind of mentioned about ETFs, so of course there's implications for people that are just stock market investors, right? And so even though we introduced it earlier as the 18-year real estate cycle, there's a lot of overlap, I expect, right, with regards to what happens in the financial markets and what's happening in the stock markets as well. And kind of the same things that perhaps what are driving real estate are also driving the stock market, either higher or lower.
Yeah, I mean, in the book, I refer to it by various sort of names just to show that it's sort of, you can refer to it different ways. But the most often I call it the 18-year economic cycle. This is the main economic cycle, which is, you know, when you get the crisis at the end, that is the crisis, the recession that you really need to pay attention to. Until that point, while you do get sort of fluctuations in economic activity, you don't get sort of major crises in the same way. So I think the important point that I make in chapter 2 of the book is understanding why real estate in particular, and it's really land we're talking about, is so central to the cycle. And so it's not just for real estate investors, though, of course, you most obviously see the cycle in the real estate market. It's also for stock market investors, because the stock market rides the cycle up and down. And I've shown that to my subscribers. Commodities also fit in, because when you get a major land boom, as you do in the second half of the expansion of the cycle, you know, that creates demand for commodities. And because, you know, people are constructing so much, you typically find in the second half of the cycle that the dollar goes down against other currencies. I mean, you know, there's sometimes in some cycles sort of variations of some of these things, but nonetheless, the overall trend is down. That's, you know, good for commodities. It's good for emerging markets. It's good for global trade and so on. So there are different ways in which you can sort of track how asset classes follow these longer term trends if you care to do so, and if you're investing in that way.
Mm-hmm. With regards to the 18-year cycle, can you talk about like kind of where we are within the cycle right now?
Yeah, so the previous crisis, it won't be any sort of surprise to people who're not familiar with it, was in 2008. And so the next sort of peak of the cycle would be around 25, 26, and then the crisis in the years after. Now, the one variation you see if you read through history, and the history of the American real estate cycle, the 18-year cycle in America, is very well documented by business partner Phil Anderson in a book called The Secret Life of Real Estate and Banking. What you find is that you sometimes get a crisis that follows quite closely after the peak, and sometimes you find that the crisis takes a few years to kind of really sort of emerge. But so in the years after 2026, you'll expect some kind of major crisis. So that being the case, we are in the second half of the cycle. The mid-cycle recession, which you typically get around year 7, was in 2019, 2020. Coincided with COVID, but it wasn't COVID that was driving the mid-cycle recession. The global economy was slowing down. We had the initiation of the land boom phase of the cycle in 2021. Things have really gone hard, and then Federal Reserve sort of started to panic and has tried to rein it back in. But nonetheless, you speak to every economist in January, they're saying we're guaranteed to have a recession in 2023. And then we had problems with Silicon Valley Bank and First Republic and so on, and we were guaranteed to have a banking crisis that was the first domino to fall. And then we were supposed to have a commercial real estate crisis, and so on. And yet, really, what has fundamentally happened is the US economy has powered ahead. It's been much stronger than people have expected. And this is a function of where we are in the current cycle. Federal Reserve is always behind the curve. This is not new to this particular iteration of the cycle. And so you might expect them to continue to kind of try and seem to do something by raising rates, which has spooked a few investors over the last 12 months or so, but not in any major way. And I feel that the continuation of this construction real estate boom will continue. And you're seeing that reflected in, for example, the amount of activity that's going on in many real estate markets, particularly residential real estate markets around the country.
Yeah. When you'd mentioned about the peak kind of coming around maybe 2025, 2026, and then that would be followed with a crisis. And you'd mentioned that sometimes the crisis itself could take a few years to kind of fully play out. So if that's the case, would you expect the full effects of the crisis to hit sometime by 2030 or sometime before that, I guess? And then once that happens, would you then see the beginning of the next cycle thereafter?
In the 19th century, the UK and the US, they had their own 18-year cycles, but they weren't synchronized. In fact, they were almost at opposite poles. So when the US was in crisis, the UK might have had its mid-cycle kind of slowdown, and vice versa. And then everything sort of reset, it seems, at the same time after the Second World War. Well, I think it's probably for obvious reasons. Reconstruction and demobilization all happened at the same time. And then we saw in 2008 that actually is even more global than that. And I think cycles have been increasingly synchronized over time. And, COVID had the further effect of, pushing economies into recession at the same time, and then pulling economies out of recession at the same time with all the stimulus work. So actually, there are two consequences of that. One is that there's the possibility that the next crisis will be really even more significant than the previous one. That is a possibility. Sometimes things play out a little differently depending on what happens in the years up to that. And then the second consequence is that the trigger for the crisis, which in 2006 and 2007 was problems in the US subprime market, which then kind of spread globally. The trigger for the crisis might be somewhere outside the United States. Could be somewhere in China or the Middle East. So it's, I suppose there's a couple of things to say about that, is that it's not going to be easy necessarily to spot where it starts, and it won't, it's also maybe not so easy to kind of anticipate right now how it will play out. But you know, if you're on the lookout, that's enough. If you're looking out for a crisis, you're going to make slightly different investment decisions and business decisions, which in itself will help you navigate problematic years much more than people who are ignorant of the cycle.
Mm-hmm. What could people expect for the remainder of the next few years that we have left in this cycle? What should people be expecting, whether it be real estate or in the stock market? What kind of expectations should you have?
Yeah, I mean, again, so these are sort of this particular stage of the cycle, and the next one, sort of chapters 10 to 14 of the book, and sort of documented in great detail. But just to give you a bit of an overview, so I'd expect to see a continuation of the current sort of acceleration in house building and other things that is going on. I do think at some point the Federal Reserve and other central banks will wake up and realize that actually what they're doing to interest rates is actually not particularly helpful. It's probably not quite having the effect of bringing inflation down. I think inflation is coming down of its own accord as we've come out of the sort of post-pandemic and Ukraine war adjustments. That I think will ignite the really speculative phase of the cycle, which you get to the peak. You know, look, I'm saying these things in sort of fairly general terms. Obviously, in the moment, it will seem quite different, and news will say this, that, and the other. There'll be a lot of news about very speculative schemes. I mean, we're already seeing quite a lot of it coming out of Dubai, which is having a construction boom again, similar to the period after about 2002. So the history is very much repeating there, but it's added to it sort of what's going on in Saudi Arabia and other places. You'll see higher prices at auction for artworks and all these sorts of things that indicate that actually people are feeling quite confident. They have a lot of money. They want to be very showy with their wealth. And in fact, it's also very, very distracting. And so investors will struggle to maintain an even keel in that sort of environment.
Yeah, and if I remember right from our previous discussion, that speculative phase that you talk about, that's where the most amount of, let's say, price appreciation takes place on a how would you say, if you're looking at it on a line chart, the curve increases the slope dramatically in terms of the price appreciation because of that speculative phase that really like kind of kicks in. So even though there may have been price appreciation prior to that, it was kind of more milder on a smaller scale. But in that speculative phase, it really like increases quite a bit, doesn't it?
It sort of depends on what kind of asset class you're talking about. But yeah, I mean, that the general thing is that, you know, when markets are at all-time highs, everyone who's on the long side is by definition in profit, right?
Yeah.
And that has its own, that generates its own unique behaviors. You don't really want to sell. So anyone who wants to buy in has to, you know, is chasing a smaller number of stocks or whatever, smaller number of properties that are on the market at any particular time. You also have very abundant credit creations and banks really pushing out loans into the market because that's how they earn fees and interest. And that makes it easier to buy. So you margin lending on stocks and other things, you know, borrowing for houses goes up. It might not be that every single city in America is always experiencing the same thing at the same time. I mean, there's always local factors. Doesn't mean that every company will appreciate in stock price. I mean, there is, you know, some companies just not very good companies and people aren't wanting to buy their shares. But yeah, in general, it's easy money, lots of confidence, lots of FOMO. You don't want to miss out.
Yeah, that totally makes sense because you kind of, it's very easy to see that, especially with cryptocurrency, right? You go through these phases where, you know, Bitcoin, you know, kind of goes through these lulls and, you know, these corrective phases and, you know, and they can be pretty sharp too, like 85% or more. And then all of a sudden, right, it starts to price consolidates. There's accumulation that takes place. And then there's kind of like this huge speculative, you know, phase that kind of like sets in. but that emotion of the FOMO, like, really starts to like, set in too, because people who had no idea what cryptocurrency was or Bitcoin or any other thing out there that trades on a blockchain, all of a sudden they're talking about it, right? And so that once the average person or your Uber driver is talking about these things, it's usually a telltale sign that you're in that speculative phase, right? And you're probably near the top or pretty close to it at that point. Yeah. So I can kind of relate when you brought up cryptocurrency, because I remember in the last kind of like, blow off cycle with Bitcoin, that's exactly what's taking place. Like you would see news articles and headlines on Yahoo, for example, right? I mean, Yahoo is not a financial go-to source, but if the average person's reading these types of headlines, then they're more than likely kind of like, getting involved and kind of wondering like, oh, maybe I should be investing in it too, or I should be buying it. So
yeah. And then it's reinforcing because in the past when people read paper magazines, the thickness of, I don't know, Vogue used to get greater towards the peak of the cycle because there's so many adverts. Oh, wow. But advertising is the kind of foundation of the internet economy. So you'll get lots of advertising pushing lots of things related to real estate and finance, maybe in unlikely places because suddenly there's a new audience for some of this thing because they've read someone or they've heard someone about someone who's made a lot of money in certain things, and so it all becomes part of the thing. And I give the example of the 1920s in the first chapter of the book, which was the equivalent period. The Roaring Twenties was the equivalent period in the cycle that culminated the Wall Street crash of 1929. And I say that there was an English journalist that was visiting his American friend, and he went downstairs to where all the servants used to work and had their accommodation, and the owner of the house had to put a ticker tape downstairs so that the servants could follow movements in the stock market, which basically shows that everyone was in on the game of speculating in stocks in the 1920s. A lot of companies, half the shareholders were women. It's not commonly thought of necessarily as a pastime that women partake in, but actually in certain periods everyone was involved in it. And so I don't mean to say that women aren't investors, but you typically see with a lot of finance audiences kind of quite a male dominated industry, male dominated audience, but actually there are phases when everyone has been involved in it. So these are very strange times in hindsight, but in the moment people are all sort of taking part in it at the same time.
Yeah. Real estate is a very localized thing, but generally speaking, given where we are in the cycle right now, do you think that it's too late for people to be accumulating or buying properties and real estate, whether it be residential or commercial?
You typically borrow money to acquire it, and actually that's leverage is part of what makes real estate a great investment. But you always buy in locations where there is inward demand, people moving in, businesses relocating and wanting to acquire property or rent property in that location, and that doesn't change. What you tend to find though as the cycle progresses is that people have already sort of bought out the center of cities or the best locations, and so the cycle tends to ripple out. Then you look at the next area and the next area and the next area. That's perfectly fine, and you find a good location. Say you're buying a house, you don't want to buy something that is the most expensive house on the street. You want to be in a place where the median buyer is interested in that kind of property, and so on. But what you tend to find as a cycle ripples out is that you get into smaller places where maybe the market is a bit thinner, and that means it can be more volatile. So it can go up much more quickly, but it can also come down much more quickly. And so the later you buy, the more due diligence you need to do as an investor. You always need to do due diligence, but you really need to make sure that the assumptions on which you're buying that place is really kind of, they're robust. You can see that actually there is companies moving in and it's going to push up demand for living in certain areas and so on, and it's a good area because there's good school and there's nice parks and good infrastructure and so on. And then the other thing is to make sure that you're not over leveraged, and that there's no possibility that you might have to be forced to sell the asset in the crisis, because then you'll be a forced seller, you'll have to accept a much lower price, etc. So, and that's actually a general rule for investing. Even if you buy at the wrong time, if you can hold, eventually you should be okay, unless you bought a total dud. But for most things, you should be okay. But if you're forced to sell in the crisis, which you might be if a bank is calling in a loan or something, then you can be in real trouble. That's when you can really get wiped out, because then you'll be forced to sell high quality assets to make up for the loan.
Yeah, those are great points. And you're right. If you can weather the storm, then, for the most part, you'll be fine. And I guess you'll already be positioned for the beginning of the next cycle as well, too, in that regard. So not being over leveraged, having
if you have a cash pile, and in fact, that's one of the key pieces of advice in the book, is to, when everyone is going crazy and buying stuff, is to start to build up a cash reserve, so that when you do find a period of low priced assets, you can step in and take advantage.
Yeah, well said. I mean, and that can cause confusion too for investors when they hear about certain periods, like, for example, over the last, or even just like recently, like when you hear about large institutional players, having lots of dry powder, being more particular about what they're investing in. It can kind of lead to confusion, because you're like, oh, well, maybe we're already there, right? Because I'm hearing about these larger players, increasing their cash reserves. And that's probably due more because of their uncertainty on their end, not knowing perhaps an understanding of the cycle itself, right? Or maybe perhaps also a combination of they themselves maybe understanding or having an inherent sense of the cycle, but what they're doing is they're being more particular about how they mobilize their cash and how they mobilize their capital, right? And so all these conflicting things can cause confusion, because I know, like, when I look back on previous cycles, it's been confusing at times, because you'll hear certain headlines that larger players, family offices, institutional players out there, they're pulling back a little bit at the moment. And so when you hear about that, you're like, oh, well, maybe I should be doing the same thing too. And it doesn't always kind of translate like that, because they may have different reasons for why they're doing it. And so I think a book like yours kind of helps to build a broader understanding and a broader knowledge for people, so they can sift through all this information, because sometimes it can be very overwhelming in terms of the information out there and what's being presented in the media.
Yeah. Well, I mean, even the idea that they're pulling back as opposed to just waiting for the next opportunity that meets their criteria. I mean, the whole framing, I mean, I suppose the reality is that in order for news to sell or gain attention, it has to be dramatic. And so when you have a bit of a wobble in the markets, to kind of then have a headline saying, oh, these large institutional players are pulling back, as opposed to just waiting for the right opportunity, it has a very different framing, and it can lead smaller investors down a different path depending on what they're reading. So just knowing that it has to be dramatic is, I think, probably a useful thing, because they can sort of take some of the noise out of what they're coming across.
Yeah. And kind of on that point, making smart investment decisions, can be very difficult at times for people. You've got herd psychology, you got these prevailing emotions, and they can be very powerful agents. What advice can you offer to people so that they can better kind of manage their emotions and maybe kind of act more rationally, so that they don't kind of get caught up in some of these these things that maybe kind of like may stop them from moving forward, instead of just like, not being over leveraged, doing more due diligence, and still continuing to build wealth?
Read my book. Become a subscriber of mine. Look, I mean, I don't want to, I've given all these sort of statements throughout the podcast interview about this, what's happening next and so on. I mean, in the moment, as I've said, it's difficult because you're bombarded by all this conflicting information. And as I've pointed out, it's intended to create a reaction. That's how they make money. It has to be emotional. And I don't think there is any way to go through it other than having a sound framework that has stood the test of time, and I believe that I provide that through my writing. And even if you do have that framework, and I know this from talking to some of my subscribers, I can almost, if I was paying attention to the emails as they come in, I could almost pick the low in the market, because that's the day when I get the most emails about, oh, are you sure the cycle's on track, and so on. So even, and these are people who've been reading my work for ages, and even then they have these sorts of emotional reactions. So it's not easy. But you know, it's having an advantage which other people don't possess, I feel. As long as you are prepared to do the work to really understand how it works and why it works and why other people don't see it. And actually, I follow a number of podcasts designed for large institutional family office investors. You know, so real kind of macro strategy stuff. And these guys have experience of finance and markets and Wall Street and so on, that, you know, I far above what I have. And they just don't, you know, this year they've been all over the place, well, actually last 12 months, 18 months, you know, we're going to get this, we're going to get that. 6 months later, no, we're definitely going to get a surge in gold prices. We're definitely going to have, you know, a major crash in this, and you know, the stock market's going to come down and so on. And, you know, none of it happens because they don't themselves possess the framework, and they're also seesawed by events. Now, maybe they have longer time horizons, and maybe they're a bit smarter about when they buy, so they only buy things when they're actually what they regard as cheap in price. And so even if they can't interpret events correctly, their actual decision making is not so bad. But you know, if they're confused, it's quite difficult for smaller investors, and smaller investors, I think, are more prone to hitting the buy or the sell button than they are. And it can be problematic. So yeah, you need to understand the framework. You need to maybe even stop reading the news. And I think those two things will help quite considerably.
Yeah, and I think that's where the real value of a book like yours really comes into play, because it provides, like you said, that framework and kind of, you know, actionable, practical advice that people can take away. You know, someone that's listening to this discussion, you know, I'm sure they're probably still wondering, like, well, if this 18-year cycle, you know, goes back centuries and it's so consistent, and you just mentioned right now that you know, you follow and you listen to the so-called experts out there in the industry. Why is it that they're so unprepared, you know, as each leg of the cycle kind of plays out, even though it's done so very consistently going back, you know, a couple centuries or more? Like, I'm sure there's someone listening that's kind of wondering this in their head, like, all these people, all these supposed gurus, and even central bankers, right? You know, that some look to them as, you know, the demigods in a way, right? Like, the world lives and dies, you know, depending on what central bankers do with interest rates and what actions they take and what they do with the monetary supply and all that. So what would you say to someone who kind of wonders, like, I still don't understand, because the experts, how could they be wrong, you know, most of the time?
Well, the experts clearly haven't read my book either.
Of course.
But on a more serious note, and I actually cover this quite early in the book, chapter 5. I mean, I point out that economics as a discipline has evolved since its roots in classical economics from, you know, David Ricardo and Adam Smith and so on, has evolved considerably. And one of the unfortunate consequences of that, and as I point out in the book, it's actually quite deliberate, but that's kind of a story for another day maybe, is that kind of land as a central, most important factor of production is absent from economic models. And so you effectively are trying to understand the economy as if it were a flat plane, i.e. it has no location, doesn't matter, and the dynamics of the land market are not important, which is a major blind spot. And so you can't therefore see or diagnose an economic cycle which is driven by what's going on in the land market. I mean, that's the fundamental reason. Now, it is also the case, if you read the history, as I've said in Phil's book, and you'll get a sense of it from my book, that the iteration of each cycle is different. It's not the case that it happens exactly the same way. It's not like securitization and what do you call those things? Collaterally based sort of mortgage bonds and so on are going to cause the next crisis.
Yeah, like the mortgage-backed securities. Yeah,
mortgage-backed securities. Yes.
Yeah.
So I had a slight brain freeze there. It's going to be something else. The location of the major boom is not going to be, tertiary cities in America this time. It's maybe going to be crazy stuff in tertiary cities in China or somewhere in Africa or the Middle East, right? And also the economic environment looks very different. There are different technologies and there's different behavior. There's social media, there's crypto, there's AI, there's all this, that, and the other. None of this was, everyone has a smartphone. None of this was around last time. And if you go back to the 19th century, the US until the 1850s was largely an agricultural economy. It sort of, then became industrialized. So, but the fundamental dynamics that lead people to speculate, to borrow too much, to over leverage and so on, they don't change. And until they do, you'll get the cycle repeating, as it were. And it seems to be 18 years because that appears to be the time when we forget all the lessons from the previous cycle and when a new cohort of decision makers who are equally ignorant about the fundamental dynamics are making most of the decisions. They don't have to be making all the decisions because, as I said, the trigger might be some other country that might not have experienced the previous cycle in quite the same way or even much at all. And so everyone is sort of investing on the basis that, this is a new era. The story behind the growth, we've got all this reserves of oil and that's generating a lot of revenue and we're diversifying into new economic spheres as is going on in Saudi Arabia and so on. This leads to a new dynamic and a new era. Technology is a big part of the feeling that this time is different and so on. And I think, frankly, no one really wants to read history. They're kind of more interested in the future and all the exciting things that are happening. And so there's a lot of reasons why people don't see it. And I don't think they ever will, to be honest. I certainly won't sell enough copies of my book to educate everyone, no matter how many people listen to your podcast, unfortunately. And so the majority of people are going to be behaving in ways that has happened before, and we have the same results.
Well, and I think that's more power to those people that'll, grab a book like yours and read it and not just read it, but understand it and follow it, right? And, that gives them, a real competitive advantage out there in terms of not being swayed by whatever the prevailing emotion happens to be or sentiment, and that they're able to make, the best investment decisions for themselves or for their family, or at the end of the day, maybe not pulling the trigger on something, right? And so it empowers them in that sense. So a book like yours really helps in that regard.
Yeah, that's the idea. And the reason you asked me at the beginning about the sort of motivation for writing the book, so my family's business, I can't remember if I said this when I last came on, my family's business experienced a very difficult set of problems after the last crisis. And in fact, some of those problems are still with us today. And I really could not believe that we were unprepared. I mean, not because we'd done anything wrong, but there was no sort of indication this was coming. And the Queen, the late Queen, when she went to the LSE in 2008, and I refer to this in my book, she asked for a briefing about, the crisis and why it was so bad and what was going on. And she got one. And she said, well, if this is going to be so big, why did no one see it coming? I mean, all the best questions are the most simple questions. And so I didn't, I thought at that moment that I don't want to go through this myself and my family again. Want to be prepared, want to understand how these dynamics work. And I don't want other families to have to do that either. So it's exactly why I became interested in the idea of economic cycles and trying to find out how you could be prepared. And that sort of led ultimately to writing this book.
Nice. And I think it's safe to say that as long as a lot of the fundamental drivers that you kind of talked about during this interview, and also in your previous one as well too, as long as they're still in place, there's no reason for anyone to believe that this time around is going to be different and that the cycle is going to stop playing out, or it's going to stop repeating the way that it has before, right?
Yeah, it'd be difficult to bet against it given the historical weight.
Yeah. Akhil, do you have any final thoughts that you'd like to share?
Um, no, I just wanted to say that yeah, I mean, I having studied this thing now for over a decade and so on, and having tracked the cycle in real time, and have found it actually to repeat like clockwork, despite all of the kind of issues that we've had in the last 2 years, but in fact, even since 2012 and all the changes, it can sound like it's sort of very easy to navigate. I mean, I don't want people to go through this and think, oh yeah, I know exactly what's going to happen all the time. I mean, it does take some deep reflection and some almost courage of your convictions as well to kind of see through the noise and so on. So it's not easy. I don't want people to think I'm being glib about all this stuff, and it's taken quite a lot of effort to help me see the way things work in the way that I do. But hopefully some of your listeners will pick up the book and get the benefit of some of that, because it really is put out there to help people.
Yeah. Your book, and also Phil Anderson's as well too. Two very, very great books that I think that need to be on just about everyone's shelf, regardless of whether or not you're a business owner or investor. But these types of books, I believe, they may not be accepted within the industry as classics, but I look at them as like classics because these help you, like you've said, to build a framework and an understanding of what is going on. And you've also alluded to the fact that, yeah, things kind of play a little differently in each cycle. They're not the same every time. And you've kind of mentioned about how, because our economies and everything's becoming more and more globalized, that, the next crisis can stem from somewhere outside of the Western world, or it could stem from outside of the US or in the United Kingdom. And so these are things that people need to be on the lookout for. And it's kind of funny because it seems like every time something happens, someone's always talking about China, right? And so the next crisis could stem from something going on in China, perhaps. And so just something for people to be aware of, that, everything's become more and more globalized and interlinked in terms of, all the economies. And so, again, you brought this point out a number of times, and it's something for people, I think, that to be mindful of moving forward, as we kind of like transition from, where we are in this cycle and into the next one as well.
Yeah, indeed.
Akhil, how can people find out more about you and of course, the book itself?
Well, the title of the book, I don't know if they can see that in the corner. It's called The Secret Wealth Advantage: How You Can Profit from the Economy's Hidden Cycle. It's available on Amazon and other sort of book websites, and also in some stores. I think Barnes and Noble in some places has stock. You can find out a bit more about the book on the book website, which is www.thesecretwealthadvantage.com. And if you are more interested in the work I do with property share market economics, you can visit us on the website. I can send you a link, propertysharemarketeconomics.com. There's a free newsletter. People can get a weekly update on things. And yeah, take it from there. Yeah.
I actually get your free newsletter as well too. So I believe it comes just about weekly, it seems. So
right, yes,
it's a great newsletter, and it talks about things on a global level, because sometimes it even has stuff written about what's going on in Australia as well too.
Yeah, we have subscribers in the UK, Australia, and the US. But I mean, these economies are quite closely linked, and they're quite similar in some ways, particularly in relation to the real estate market. So it's quite good for any audience to sort of be aware of what's going on. And we try and explain. What we do is we try and take stories from the news and other things, developments, and we relate it back to the cycle and try and explain the significance of what's going on, and what it means for the progress of the cycle. So I'm glad you're a regular reader.
I am. But just to clarify too, you also have a paid newsletter service as well too, that if people are interested in getting kind of more in depth and more into it,
that's true. Yes. Right? So we have a couple of different membership tiers. So of an entry level newsletter, in addition to the weekly newsletter, you get a monthly long form essay where we go into more detail on certain topics. So we did an update on crypto or AI or inflation and so on. We've done some analysis which pointed out that whenever you get a period of rising interest rates, as you always get at the second half of the cycle, house prices always go up. So everyone's sort of expecting house prices to crash over the last few months of, I think they'll be waiting for a bit longer. So, we do things like that. And then if you want to become a full PSE subscriber, you get a lot of additional content. In addition to those things, we produce an annual stock market forecast, which includes the Dow Jones, the NASDAQ, the UK and the Australian indices. We produce commodity forecasts, including gold. We run webinars. We have a set of indicators we use to track the cycle, and various other things, watch lists of interesting stocks that are tracking the cycle, etc.
Okay, great. Yeah, so there's a lot of resources and a lot of content and information that you guys are putting out. So that's great. And we'll include links to these resources that Akhil's mentioned. We'll include all this in the show notes as well, too. So when the listeners if they're interested in learning more about and finding out more about these resources and content that you guys put out, they can easily get access to it as well. So Akhil, thank you for coming on to the show today.
Thank you so much for having me. It's been a real pleasure.
Yeah, same here. I really appreciate all the insights that you shared with the listeners today. And until next time, that's all for today. Thank you and have a great week.
Thank you for tuning into this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.